Bismillahirrahmanirrahim. My name is Afzal Shad and I'm back with another topic of IGCSE and levels of accounting. So today we're going to discuss partnerships. It is going to be an introduction of the partnerships today. Actually, I've divided the partnerships into three parts. In the first part, we are going to have a background study of the partnerships, and we will see what are the differences between the sole trader and the partnerships in theoretical form and as well as in the financial statements form. Then in the second part, we'll be discussing about the appropriation account in detail. We'll be drafting one appropriation account as well, so that you can have an idea how to make an appropriation account. And then in the third part, we are going to discuss about the fixed and fluctuating capital accounts, in which in the IGCSE and O levels past papers, there are mostly the questions related to you have to make a capital account, in which either he's going to ask you about creating a capital account using a fixed capital structure, other way around he can ask you to make a T account using the fluctuating capital structure. So we are going to discuss all of these three things in detail. So let's get back to the partnerships, a brief overview of the partnership. So today we're going to have a discussion on the types of business organizations, like the sole trader versus the partnerships. You have already gone through these things in IGCSE business studies maybe, so you know the basic difference between the sole trader and the partnership, but we'll give a quick sneak peek over that today as well. Then advantages and disadvantages of forming a partnership, that if you are going into a partnership, converting your business from a sole trader to a partnership, what are advantages you can gain and what are the drawbacks to that. Then we are going to discuss about the types of partners in the partnerships. Then we are going to discuss partnership agreements, the importance of the partnership agreement, why should we have an agreement while going towards a partnership, and what are the brief contents of the partnership. So this is going to be very helpful for you in the real life. If you are going into the partnership, you're starting a business and you want to go into the partnership, you must know what really partnership agreement means for a business, and why is it important, and what are the ingredients that must have to be there into the partnership, so that you can run your business smoothly. Then difference in financial statements of the sole trader versus partnership. So till today, I assume that you have already gone through the income statements and statement of financial position of the sole trader, and you have a brief idea about those income statements and statement of financial position of the sole trader. So today we will be discussing what is the difference between those financial statements of the sole trader versus the financial statements of the partnership. So partnership, the types of business organizations. First is the sole trader. So what is sole trader? Sole means one, and if one person is managing all of his business, that's called as a sole trader. So all profits and losses are transferred to his own capital account. So if you have already gone through the income statement of the sole trader, you must have drafted the gross profit, and then in the profit and loss section you have drafted the net profit, and then you must have known that that chunk of the net profit, the actual amount of the net profit, was going into the capital accounts in the statement of financial position. So whatever net profit is, let's suppose if you have drafted a income statement and the net profit was, let's suppose, $5,000, what you were doing is you were actually transferring that 5,000 and you were adding it to the capital account in the statement of financial position in the sole trader. So all of the profit, all of the net profit was going into the statement of financial position and was added to the capital, and God forbid if there was a loss, it was actually deducted from the capital account of that sole trader or sole proprietor. Then net profit from trading and profit and loss account is transferred to the owner's equity. That's what I have just told you, that whatever net profit which we were getting, for example $5,000, it was going into the capital accounts directly. So there was nothing else in between the net profit and the adding it to the capital accounts. Now talking about the partnership, a partnership when two or more than two people are joining their hands and want to start a business or wants to continue a business, that's called as a partnership. So there are more than two owners. So remember one point, that in sole trader there was one person who was managing, who was the owner of that business, and in partnership there are more than two owners, two or more than two owners into the business. The profit and losses are shared according to the profit and loss sharing ratio. Obviously, there are two people now. All of the profits cannot go to one person. Like in sole trader, for example, you had 5,000 profit, it was going to one person. But in partnership, as there are more than two or more than two people, so the whatever profit there is, it is going to be distributed amongst the partners. Let's suppose, if I give you an example, if the question says that the profit is going to be equally transferred or equally splitted or equally distributed amongst the partners, that means if you have a profit of 5,000, you have to equally distribute it, like divided by 2, you get the amount of 2,500, and you split up 2,500 in partner A and give 2,500 rest to the partner B. So in the partnership, whatever net profit or whatever the profit at the end of the day we are getting, that is going to be split up amongst the partners. So net profit from trading and profit and loss account is transferred to the appropriation account. So where the account where you are actually transferring those amounts or splitting those amounts or appropriating those amounts amongst the partners is called as the appropriation account. Coming towards the advantages and disadvantages of a partnership. So the first advantage towards a partnership is additional capital. Why you convert from a sole trader towards a partnership? Obviously, two are always better than one. If you are adding one more person as an owner to your business, that means he or she is bringing in at least additional capital, some amount of money into the business as well. So if you are if you're looking for a money, it is a very good alternate of getting a bank loan. So you might have already gone through these things in the business studies. Second is more skills and ideas. Like if some new person is coming in, maybe if they are not bringing in a lot of capital, but they are bringing in the management skills, they might be bringing in the accountancy skills. If you become the partner of some business, you in the future you will be a very good accountant, so you will have a skill of accountancy with you, so that's going to be a very good add-on. If you don't have a lot of capital in your hand, still you can be a very good partner of a very good firm because you have got an additional skills. So partners bring in more skills in the organization. Better decision making. Obviously, if one person is making the decisions, there are more chances of doing the errors, there are more chances of doing the mistakes, and there is nobody who is going to do an audit or going to do a cross check on that. So if there are two people, obviously, or more than two people, they will be negotiating before making any agreement or making any decision for the business. And obviously, whenever you are negotiating or whenever you are discussing any stuff, you reach up towards a better result at the end of the day. So better decision making is always an added benefit for a partnership. Then sharing the burden. One person cannot do all of the thing if the business is expanding. You cannot manage operations in multiple cities, or you cannot manage multiple type of the operations. One can be good at finance, other can be good at marketing. So the person who is good at marketing should be like dealing with the customers and upselling the things, and the person who is good at finance should be managing within the office. So in the partnership, you are sharing the burdens. No, but still there are some of the disadvantages towards a partnership. The very first disadvantage is sharing of the losses. So if you are sharing the profits, the alternate is you have to share the losses as well. If the business is incurring any loss due to any calamity, obviously you have to bear the burden for that as well. If the business is having a loss due to any negative decision of the other partner, you have to be liable for that as well, because now you are sharing the burdens. So sharing the losses is a disadvantage. Then sharing of the liabilities. Let's suppose if one person is taking a loan from a bank and we being in the business or not being capable of returning it back, obviously the more and more interest has to be paid back. So if you are taking the loan, if one person is taking the loan, other partner still has to bear it as well. So sharing of liabilities is another disadvantage in the partnership. Then there might be conflict or disagreement between two or more than two people. Obviously, if there are two people, there might be some conflict. One may say that we have to expand the business. Other may say we don't have to expand the business. We should be defensive because right now we are not having that higher profits. So both of them might come up to a conflict, or there might be some disagreement between both of the partners. Then loss of autonomy. One person was managing everything, one person was all in all of the decision was his own. But right now in the partnership, whenever you are going to make a decision, you have to first put those things on the table in the discussion, and once every partner, or at least the majority of the partners are approving those things, then it is going to be implemented. You cannot implement it just after getting an idea of it. So autonomy is lost. So there are some advantages, but there are some disadvantages to everything, just like the partnership. Now coming towards the types of the partners, the first type of a partner is called as the general partners. General partners are partners having the unlimited liability. As you have known that partnership and sole trader, one thing is common between both of them is they have got the unlimited liability. Like if you have got a loan for the business, it is not a loan for a business, it's of your personal loan. Let's suppose if you have got money, $10,000 from a bank, and your business collapses, and at the end of the day your business is unable to pay back the debts, the bank is still going to hold you liable for paying back that loan, because the loan is not granted to that business, but the loan is granted to you. So in sole trader and partnership, that's the biggest problem, that whenever the loan is granted or whenever there is a liability on the business regarding anything, you are supposed to be liable for that as well. So all partners are liable if they are general partners. So general partners are having that burden of unlimited liability upon them. Then at least one partner in an organization or in a partnership must be a general partner, so that there should be one person at least whom banks or whom the people who are lending the money should come and should go to and ask the money for that, because generally it's a partnership, it's the nature of the partnership that it has to be unlimited liability. So at least one partner out of 2, out of 3, out of 5 should be a general partner who is going to bear the unlimited liability burden onto his own. Then general partners are, but there is obviously a good thing behind the general partners, that they are the decision makers. Actually, why they are the decision maker? Because they are bearing the burden of the unlimited liability. That's why we give the decisions in their hands, because they are at the risk. So they are the people who are going to decide the future of the organization or the partnership. So if there is one partner in a partnership who is a general partner, all of the decision is being made by him only. If there are two partners who are a general partner and one partner is not a general partner, so those two partners who are the general partners are going to make all of the decisions. So remember, they are having unlimited liability. It's a bad point, but the good point is they are going to be decision makers of the business. Then the alternate of the general partner is the limited partners or the silent partners. Who are the limited partners? The partners having the limited liability in the business, just opposite to the general partners. You can, in short, you can say they are the investors of the business. They just invest the money into the business and they are not very much interested in the day-to-day decision making. At the end of the day, what they are interested is in the profits of the business. If the business is reaping the profits, that's only the interest of an investor always. So limited partner and silent partners are kind of the investors or the silent investors of the business. They have the limited liabilities up to the extent or up to the amount of the investment they have done. So if somebody has given $10,000 to the business, the max he's going to lose is the $10,000, not more than that. He's not going to bear the unlimited liability burden onto himself because he was just an investor. A partnership must be registered as a limited partnership. If there is one, even a single person is a limited partner. In UK and in US, we call it as a limited partnership, so that the word limited tells us that this partnership has got some people who are the silent partners or who has got the limited partners in it. If all of the people are general partner, it is not necessary to call it a limited partnership. We can simply call it a partnership. So a partnership means general partners. Limited partnership means at least one person is a limited partner in it. Then limited partners have no formal role in business management. So as said, in general partners, they are the decision maker because they were taking the risk. In limited partners, they are not taking the risk, so they are not making any decisions, any day-to-day decisions in the business. I hope this thing is quite clear now. Moving on to the next part, that is the importance of a partnership agreement. Why we are going for an agreement? Why is it necessary? Because chances of disagreement in future. You have invested your amount, I have invested my amount. Let's suppose in future we have some conflict or disagreement and you want to split up. How will you split up? How much portion of the profit are you going to get at that point? How much capital you are going to get back? How much portion of the assets are you going to get back? How we will sell up that assets? All of these things of the winding up is really important. That's why chances of disagreement leads towards, if there is a proper agreement, everything is written, that how we are going to wind up this business, or how in the case of disagreement we will litigate this, or we will have a mutual understanding, or who is going to make the decision for us if there is a disagreement upon two people. All of these things are written down in an agreement. That's why it is important. Unlimited liabilities of partners. Obviously, there is unlimited liability of two partners means that there is a lot of risk. So more the risk, we must be conscious enough. So there must be some rules of borrowing then. It is not like if there are two partners in business, you and me are doing the business in the partnership, I go to the bank and take the loan whenever I want it. So I cannot do that. Reason is, if I'm taking more and more loan for the business, today it might seem good, but tomorrow I have to pay it back. And taking the loan by myself, it means that I am putting the burden of my loan on the other partner as well, because that partner is also a general partner. So if at the end of the day banking is not going to ask me a loan, but you yourself being the responsible of that loan as well. So that is why there must be some rules of borrowing. There must be some rules of doing the business, so that both of the partners are at least safeguarding their own interests as well. So partner salaries, who will get the salary and how much salary is going to be there? If let's suppose if you are giving time to the business and I'm not giving time to the business, obviously you should be entitled for a salary against the manager. If you are not going to give the time to the business, obviously we have to hire some manager for that. So, and we have to pay him. So opportunity cost concept is obviously over there. So if you are putting the burden, if you're like putting in time for the business, giving the time to the business, obviously you deserve some salary for that. If I'm not doing that, if both of the partners are giving time, then we can say that both of the partner can get the salary, or both of them are not getting it. That depends. But if one partner is giving more time, he or she should be entitled for a salary. Then admission of a new partner. If let's suppose in future we want to admit new partner into the business, how will he contribute in terms of capital and in terms of goodwills and in terms of like running business, and what will be the terms of the incorporation or getting a new partner. Then in case of withdrawal or death of a partner, if one partner is deceased or die, how will partnership wind up? So all of these things are basically the risks which are involved in the partnership. In order to avoid these risks, we go into a partnership agreement, a written agreement of a partnership. Then contents of a partnership agreement. The first is partners. For what things are really important? It's not like limited to this. You can add up anything you want, but there are some things which should be the part of the partnership agreement, and the one of them is the partner's capital. So how much capital is going to be invested by whom? You are going to invest $10,000, I am going to invest $15,000. So it has to be written that this amount of money is going to be invested in the business by some person. Interest on capital. Obviously, sometime if I'm investing more money into the business, I should be entitled to have a more interest on that. Because let's suppose if you and I are not going to invest the money into this business, alternatively, we can have that money invested into the banks and we might get some interest on that. So similarly, if we have invested that money into this business, we should be getting some interest on that as well. So sometimes if all of the partners agree to have an interest on their capitals, so we adjust the rate of the interest on capital. Let's suppose 5% every year, the owners are going to get the interest. So anyone who is going to have more investment will get more interest. Opportunity cost concept tries over there as well. Then partners' responsibilities, handling operations, who is going to do the job of finance and accounts, who is going to manage the suppliers, the marketing stuff. So responsibilities are well divided in the partnership agreement. Then partner salaries, as discussed earlier, if somebody is like investing more time into the business, he or she should be entitled for the salaries. So how much salary is going to be there, it has to be written, and how much increment should be there after every year, it should be written into that partnership agreement. Then profit and loss sharing ratio. It is not necessary that if I have invested $15,000 and you have invested $10,000, that I should be getting 1.5 and you might be getting 1.0 ratio of the profits. We might be sharing equal profits at the end of the day, even without I have invested more into the business. It might be, it depends on the partners how they are agreeing, but whatever they are agreeing, whatever ratio they are agreeing, it should be agreed upon by both or all of the partners. Then interest on drawings. Similarly, if we are having as interest on capital, if the business is paying interest on capital investment by the partners, so if some partner is withdrawing amount from the business, he should be charged with the interest on drawings. So if let's suppose 5% interest on capital is given, there should be 5% interest on drawings to be charged by the business, so that more partners should not be like pushed to take the drawings. Else, if you're not like creating this barrier of interest on drawings, what will happen? After some time, one partner will withdraw some more amount and other partner will not. If the other partner haven't withdrawn more amount, so what will happen? The other partner who has not withdrawn the amount will feel bad, because he sees that, oh, you have Mr. Partner A has withdrawn more money already and we don't have cash into this business. So in order to like create a barrier on the withdrawals, we say there is going to be an interest on drawings, and again it is going to be mutually agreed upon by the partners, and the percentage is going to be agreed upon them. And the last one is the partners loans. So if we need a loan, if this business is requiring a loan rather than going into a bank, we can ask some partner, if they have an extra amount with them, they can lend the money to the business. Obviously at the end of the day, it is going to be his benefit as well as ours. So partners loan is similarly just like a bank loan. We will discuss this partner loan in detail as well. Then difference in the financial statements of the sole trader and the partnership. In sole trader, you have already discussed about, you have already gone through the net profit, like drafting the gross profit in trading section, and then you have drafted the net profit into profit and loss section, and then that part of net profit was directly transferred to the statement of financial position. In equity section, it was added to the capital. But in partnership, that net profit is going into the net profit and loss appropriation account first. So there is an additional filter. So you get the gross profit, you get the net profit from the income statement, and that net profit is transferred to the appropriation account. Then we split up those profits and losses, like if you have to give some salaries to the partners, if there is interest on capital, if there is interest on drawings, if like and then we are going to split up or the remainder of the profit according to the profit and loss sharing ratio agreed upon by the partners. So anything that is relevant to the splitting up and giving to a specific partner is dealt in the profit and loss appropriation account. We will discuss that in detail as well. Then the amounts are transferred to the partner's capital account once they are filtered out from the profit and loss appropriation account. Remember one thing which is important, that the net profit is going to the profit and loss appropriation account first to get it filtered and to get it splitted up for the respective partners. Partner A is going to get how much money and partner B is going to get how much money, and then after filtering up or splitting up, we can like convert that or we transfer that into the statement of financial position or the equity section. So as we said, net profit and net loss is transferred to the profit and loss appropriation account, and then from this profit and loss appropriation account we transfer it to the partner's capital account, right? In sole trader, we didn't have this the mid thing, which is profit and loss appropriation account. We directly transferred that net profit to the capital accounts, but over here we have got this middle thing which is called as a profit and loss appropriation account. So that's all for the day. So if you want to have some of the practice questions or some of the worksheets related to that information, so you can have that from afzalshad.com. You must have to watch the next video, which is the second part of this, in which we are going to discuss the profit and loss appropriation account in detail. You must have to watch the next video. The link of the practice question as well as the next video is going to be in the description section. And then once you are done with complete topic, you can solve some of the topical questions from the book, which is Games of Accounting Season 1, written by me. Obviously it is very, like you can see, you will see that I keep on updating this Games of Accounting topical notes every year. and I inculcate more and more topics into it, so that I want the students to practice more and more on the things. After doing these topical papers, I can assure you that there won't be any difficulty while attempting the yearly papers. You will be saying that all of the yearly will become an easier task for you. So in the next section, obviously we'll be discussing about the appropriation account and interest on capital, interest on drawings, partner salaries, super profit, profit and loss sharing ratio. So these are all the ingredients of the appropriation account. We will discuss that in detail, and then in the third video we'll be discussing about the current account versus the capital account. So thank you very much for your time, and if there is anything you want to ask related to that, you can obviously punch in your answers, or you can punch in your question into the comment box. If you like this, please do subscribe, and we'll catch up in the next video. Thank you very much.